Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. As physicians, we're often taught how to manage other people's health, but rarely how to manage our own business health. Lately, I've talked to many physicians who are diversifying their incomes by picking up locums, consulting, or launching side businesses. When you start earning 1099 income, you gain a powerful new wealth lever, the ability to choose your own retirement plan. But if you go with whatever your accountant suggests, you may be missing out on thousands of dollars in tax savings. Today, we're comparing the solo 401k and the SEP IRA using the brand new 2026 limits to see which one actually moves the needle when it comes to your financial independence. Both can be great tools to boost retirement savings. Both are tax advantaged. And both are often misunderstood to some extent on when they are allowed to be used and how to be used. What I want to do in this episode is to help you actually see the difference between them. Not in abstract terms, but in real physician scenarios with real numbers. I'll walk you through 3 very common physician situations, comparing how much you can contribute if you're around age 45 versus if you're around age 55. Why those ages? Because once you're 50 or older, there's something called catch-up contributions, and that certainly plays a role here. My goal by the end of this episode is that you'll be able to say, this one makes more sense for me. Let's start with the high-level differences. A SEP IRA is an employer-only retirement plan. There are no employee contributions. Everything that goes in is technically an employer contribution. A solo 401k is a full 401k designed for people with self-employment income and no employees other than a spouse. That means you can contribute as the employee and as the employer. That one distinction alone is why the numbers look so different. When you're working for yourself and you're self-employed, you want to think about yourself as both acting as an employee, the person actually doing work and getting services and earning income, and the employer, the person running the business. Those two roles, even though you're the same person, have a difference when it comes to financial contributions to a 401k. Now let's get into the nitty-gritty details. A SEP IRA is actually quite simple. It's easy to open, it's easy to fund, there's almost no paperwork. Contributions are flexible year to year, and you can decide how much to contribute after the year ends. Yes, you heard that right, after the year ends. So you can make your 2025 contribution in 2026, up to the point where you're filing your business taxes. That being said, the account has to be open by the end of 2025. So if you don't already have a SEP IRA open for 2025, you can't make 2025 contributions in 2026. The trade-offs with a SEP IRA are significant. With a SEP IRA, there are no employee deferrals and no catch-up contributions if you're age 50 or older. You must also contribute the same percentage for all eligible employees. This means you can have a SEP IRA plan if you have a practice with employees, but if you want to contribute a lot to your own SEP IRA account, you'll also be contributing to the accounts of your eligible employees. The other big drawback is that SEP IRAs count towards the pro rata rule, which can break the backdoor Roth IRA strategy. Most physicians earn above the income limit to contribute directly to a Roth IRA, so we use the backdoor strategy. However, the IRS has something called the pro rata rule. It looks at all your traditional IRA accounts as one big pool. Because a SEP IRA is technically an IRA, having a balance in there clutters that pool. If you have $50,000 sitting in a SEP IRA and try to do a $7,500 backdoor Roth, the IRS is going to tax a huge proportion of that conversion. Balances in a 401k are excluded from that calculation, keeping your backdoor Roth clean, simple, and tax-free. So let's get into the solo 401k. A solo 401k is a little bit more complex. There's a little bit more setup, and once the assets in that solo 401k grows, there is a small annual filing requirement, though it's pretty easy to do. In exchange for all that, you get much higher contribution potential at lower incomes. You also get employee deferrals, catch-up contributions once you reach age 50, and even the option of a Roth solo 401k. There's also no interference with the backdoor Roth IRA strategy. With that foundation, let's get into the examples. For simplicity, in each scenario, there are no employees other than possibly the spouse as the one only employee. There are no part-time W-2 employees. Remember, if you hire someone as a 1099 contractor, they're not an employee. For scenario 1, we have a physician who works as an independent contractor earning $400,000 per year after expenses. Expenses meaning any business write-offs. This physician has no employees, just pure 1099 income. This is a great example of someone who only does locums work. If that physician is 45 years of age, there are no catch-up contributions yet. With a solo 401k, the physician can make an employee deferral of $24,500 in 2026, plus an employer contribution of about 20% of the net income. At the income level of $400,000, the plan hits the overall cap, which means the maximum solo 401k contribution at age 45 is $72,000. That's because 20% of $400,000 is $80,000, which is already above the cap that someone under age 50 can contribute to a solo 401k. With a SEP IRA, there are no employee contributions. The physician can contribute about 20% of their net income, which is capped at that same $72,000. This means at age 45, both plans land at $72,000. This is one of the rare cases where, purely on contribution limits, there's actually a tie. But is it really a tie? With a solo 401k, the physician can also contribute using the backdoor Roth IRA strategy, which means getting more tax advantage growth on another $7,500 for 2026. A SEP IRA interferes with the Roth conversion due to the pro rata rule. If the goal is to put away as much money as possible in tax advantage accounts for retirement, the solo 401k is still the way to go, because now this physician could contribute $72,000 to their solo 401k and $7,500 to their Roth IRA using the backdoor Roth IRA strategy. Now let's look at that same scenario, but the physician is 55 years of age. This is where there are some changes due to catch-up contributions. With a solo 401k, the employee deferral increases to $32,500 for 2026, since the catch-up contribution adds an additional $8,000. So the maximum becomes $80,000. One thing to note is that the Secure Act does require that those who have more than $150,000 of FICA wages in 2025 need to designate any catch-up contributions as Roth contributions in 2026. With a solo 401k, it just means having a traditional solo 401k and a Roth solo 401k. A little bit more paperwork, but still completely doable. With a SEP IRA, nothing changes. There's no catch-up contributions in a SEP IRA. The maximum stays at $72,000. So that means at age 55, with a solo 401k, you can contribute $72,000 pre-tax into a traditional solo 401k and $8,000 post-tax into a Roth solo 401k. Compare that to the SEP IRA, where the maximum contribution is $72,000, which is all pre-tax. Same income, same work, but the solo 401k allows for that additional $8,000 in catch-up contribution. It also allows for the backdoor Roth IRA strategy to stay in place, which means at age 55, you're able to contribute $8,600 to your Roth IRA with the backdoor Roth IRA strategy. In total, that's an additional $16,600 more in contributions for using a solo 401k compared to a SEP IRA. Now let's look at another scenario. A physician works part-time as a W-2 employee, earning $200,000, at that job, but also does locums work as an independent contractor earning $100,000 after expenses and write-offs. An important detail in this scenario is that the W-2 job does not offer a retirement plan for part-time employees. Let's look at our 45-year-old physician. Because there's no employer plan in the W-2 job, the physician can create a retirement plan for themselves using their locums income. With a solo 401k on $100,000 of 1099 income, the physician can contribute the employee deferral of $24,500 in 2026, as well as make an employer contribution of around $20,000, which is 20% of the $100,000 profit. This leads to contributions of $44,500 total into the solo 401k. There's also the option to contribute another $7,500 using the backdoor Roth IRA strategy. Compare that to a SEP IRA, where there are only employer contributions, which is 20% of the $100,000 of the 1099 work, or $20,000. So, at age 45, a solo 401k allows contributions of up to $44,500 in this scenario, with a backdoor Roth IRA contribution of $7,500 for a total of $51,500, compared to a SEP IRA contribution of $20,000. That's a pretty dramatic difference. You can actually contribute double towards retirement using the solo 401k and backdoor Roth IRA compared to the SEP IRA in this particular circumstance. Now let's look at the same scenario, but the physician is 55 years of age, which means now they're eligible for catch-up contributions. With a solo 401k, the employee deferral jumps to $32,500. That's that $24,500 plus $8,000 in catch-up contributions. The employer contribution is still around $20,000. This now totals $52,500. With the SEP IRA, age doesn't matter. There's no employee contribution and no catch-up contributions. It's still capped at $20,000 or 20% of profits from the 1099 work. So at age 55, you can contribute $52,500 to your solo 401k and $8,600 to your backdoor Roth IRA for a total of $61,100 in retirement contributions. Your SEP IRA contribution is limited at $20,000, and you aren't able to do that backdoor Roth IRA strategy. Again, same income, same work, very different outcomes. Now let's look at a third scenario. In this scenario, a physician owns a solo micropractice where their only spouse is their employee. The practice is an S Corp. The physician pays themselves $2,500. The spouse's salary is $60,000, and there's an additional business profit of $90,000. Because there are no other employees, both spouses are eligible for a solo 401k. If both spouses are age 45, or basically if they're under age 50, with a solo 401k, the physician can contribute $24,500 as an employee and up to 25% of salary as an employer. So the physician will hit the cap of $72,000 max contribution for the year. One thing to note is that contributions to a solo 401k differ significantly between a single-member LLC taxed as a sole proprietor and an S Corp. An LLC uses roughly 20% of net earnings after any tax deductions, while an S Corp uses 25% of the W-2 salary. The S Corp structure separates profits into salary, which is subject to FICA, and distributions, which makes the 25% calculation more efficient for maximizing savings compared to the lower 20% of the net Schedule C income for a single-member pass-through LLC. The spouse can contribute $24,500 as an employee and $15,000 as an employer. That $15,000 is 25% of their $60,000 salary. That makes for a total of $39,500 in contributions for the spouse. This means that the total max family contribution, if both the physician and the spouse are around age 45 or under age 50, is $111,500 into their solo 401ks. They can also both contribute using the backdoor Roth IRA strategy for an additional $7,500 each or $15,000 total. That means the total contribution to retirement account can sum up to $126,500. And that's just with a total salary and profits of $400,000. Now with the SEP IRA, the same percentage of pay must be used for everyone. If the practice contributes 25%, then the physician can contribute $62,500 to their SEP IRA. The spouse can contribute $15,000 to their SEP IRA, which means the total for this couple is $77,500 in contributions to their SEP IRA. Remember, there's still that pro rata rule, so there's not really an option of doing a backdoor Roth IRA strategy here. That's a pretty big difference in the amount of contributions between using a solo 401k and backdoor Roth IRA for retirement versus using a SEP IRA. Now let's say the physician and the spouse are both age 55. Now let's add the catch-up contribution. With a solo 401k, the physician can now contribute $32,500 in employee deferral, which brings her to $80,000 of total contributions after maxing out with the employer contribution. The spouse can make the same $32,500 employee deferral, as well as $15,000 of employer contribution for the total of $47,500. This makes the max total family contribution of $127,500 for the solo 401k, with some going into a traditional solo 401k and the catch-up contributions going into a Roth solo 401k, at least for the physician who's making over $150,000 a year. Then there's another $8,600 per person with the backdoor Roth IRA for a total of $144,700 in contributions that can be made in a single year. With the SEP IRA, there are no catch-up contributions and the percentages are the same, so the max contribution remains at $77,500. Here's the pattern I want you to notice. SEP IRAs tend to work best when there's a high income, no employees, and the physician values simplicity over optimization. A SEP IRA can be used if Roth strategies aren't a priority, and maybe the physician doesn't actually want to or have the means to really contribute really high levels to their retirement accounts. The solo 401k really shines when the income is moderate to high, there's side income or uneven compensation between W-2 elsewhere and 1099 income. A solo 401k also works great if there's a spouse involved in the business. The solo 401k also allows the use of the backdoor Roth IRA strategy. It also allows for catch-up contributions for anyone over age 50 to put away more in for retirement accounts. However, you can't have a solo 401k if you have any employees, though it's possible to get away with a solo 401k if you have employees who've worked for you for less than a year and work less than 500 hours for the year. So very, very part-time employees. But generally, if you have part-time employees, a solo 401k is not going to work. In almost every mixed income or spouse-employee ratio, the solo 401k allows tens of thousands of dollars more in retirement contributions per year. There are a few caveats to mention. I discussed scenarios in the case of being under 50 using age 45 and 50 or older using age 55. However, for those who are between age 60 and 63, there is a new super catch-up rules for 2026, which adds an extra $11,250 in catch-up contributions for those who are using a solo 401k. Now, what if you aren't strictly solo? The solo 401k is really for a business with no employees. But there is a major spouse exception. If your spouse works with you in the business, they can have a plan too. This effectively doubles your household tax advantage space. But what if you hire staff? If you have a medical assistant or associate, the solo 401k is now off the table. This is where the SEP IRA can become useful because it is permitted for businesses with employees. However, you do need to remember the proportional rule, where if you put 20% in your own SEP, you must contribute a proportional percentage to your eligible employees' SEP accounts. For 2026, an employee is eligible if they are age 21 or over, have worked for you in 3 of the last 5 years, and have earned at least $800. That means they don't have to have worked for you much, just for a long time. So if you have any long-term staff, even if they're very part-time, the SEP can be a very expensive way to save for your own retirement. So in closing, if you're choosing between a solo 401k and SEP IRA, the right answer is rarely about which one is better in general. It's about your income structure, your age, whether or not a spouse is involved in the business, as well as how much you want to be able to contribute towards retirement accounts in order to maximize tax benefits. You also have to look at whether or not you would want to hire any employees. And that concludes today's episode. I hope you enjoyed it. I'd love to hear from you. You can always reach out to me at growyourwealthymindset@gmail.com. I wish you a wonderful week. And remember, optimize for your life, not just for your balance sheet. Thanks for listening. And I'll see you back next week with another episode of the Grow Your Wealthy Mindset podcast. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.